AI promises to transform transaction banking, sweeping in new operational efficiencies by automating repetitive tasks like data entry, transaction monitoring, and reconciliation, providing insights into payment patterns and cash flows, and supporting cybersecurity. I'm Sarah Rundell, and in this podcast, I'm joined by members of Standard Chartered's Transaction Banking Sales team, Executive Director Amy Beninato and Managing Director Karen Hom, to explore how transaction banks and their corporate customers can begin to implement AI and put in place the data strategies to support the technology. Welcome, both of you.
Hello, lovely to be here.
Thank you, delighted to be here.
Thank you. Could we start by outlining how AI is being adopted in transaction banking and beginning to transform cash management, liquidity and trade finance, that particularly document-heavy process? Amy, could you perhaps begin on the cash management piece?
Sure, happy to. So I think as the logical first step, we would think about AI as a broad spectrum. And I can think of an immediate example that I've worked with a client on, robotics process automation, which definitely resides in the automation spectrum of AI. I had a client who embarked on a project to improve their daily cash positioning and aid them in their cash flow forecasting. And on the banking side, robotics process automation, or RPA, is also commonly used at banks in applications such as payment analytics, fraud detection, CRM automation, personalized product recommendations, more on the consumer side, certainly regulatory monitoring, and trade finance automation, amongst other things. From a bank perspective, and according to a recent EY survey, financial institutions are really focused on the benefits that will yield efficiency and productivity gains while lowering cost and hopefully leading to greater client acquisition and retention.
So Karen, could I come to you now? How is AI being used in liquidity management and trade?
Both liquidity management and trade share similarities in where AI has begun to be used, as well as emerging trends on where we can use it going forward. Let's start with liquidity management, which provides the core funding for corporates to cover not only their operating needs, which are predictive, as well as more general corporate finance needs, which tend to be a little bit more variable. Corporates with established domestic, regional, and global cash pools can use predictive analysis for cash forecasting, which can help with the timing of pulling excess funds from overseas, which are often subject to tax and other types of fee implications. Changing regulations often also play a factor. For example, in Indonesia, many banks are not SWIFT enabled, making automated domestic sweeping a little bit more challenging. A fintech solution has been introduced in the market, and Standard Chartered works closely with them in developing a compelling domestic liquidity solution. As AI continues to develop in liquidity management, it could potentially help more with those finer skills around tax and regulatory changes as it learns how corporates will use that data. Let's turn over to trade finance. For now, AI can help on the data side using pre-filled standard templates and review customized issuance language to perhaps highlight where there's variations in the text. As we see AI continuing to develop in the trade space, it could potentially help with more customer identification around the more complex trade products, such as supply chain programs.
Okay, it's going to be an interesting future. How should Treasury begin integrating AI? What are the first steps around, for example, feeding AI into TMS and processes around gathering the data needed to drive insights from AI's advanced analytics capability? Amy, have you got some thoughts there?
I do. So as an operations person, I'm very fond of diagrams and flow maps and process flows documentation. So to me, the logical first step is to develop a diagram and a flow map of all of the core systems that are involved in a client's treasury operations. And this is a huge undertaking, which is why the timelines tend to get extended. But you can't build interfaces and eventually replace manual processes with automated ones until you have the full scope and all of the dependencies identified. So at a high level, for example, accounts payable and accounts receivable, all those processes and interfaces need to be fully documented so that the opportunities for automation in those workflows can be identified. And obviously, the best candidates for AI or an application like robotics process automation are repetitive and predictable and, frankly, non-strategic processes. This isn't something really esoteric. It's all the really non-strategic operational stuff that clients deal with on a daily basis. For example, the client that I mentioned earlier had a very detailed process flows documentation. And within the process flows, she had identified 7 sub workflows. So it included things like time deposits that were maturing, outstanding investments, previous day cash flows, their investment limit calculation, which for this client was particularly important because they had very stringent counterparty constraints with their banks. So it was very important to have a handle on the investment limits. And then other things that are more granular, such as intraday payments, the collections forecast, any pending payments, and then static data management, which just chews up a huge amount of space, but is very important. And just as a side note, this particular client had said to me, each sub workflow has a happy workflow, and that's the sequence of actions when everything goes the way it's supposed to, and an unhappy workflow where actions or alerts are designed for each potential issue. And this is where the testing and the timeframes become so important. I mean, robots learn from humans through machine learning algorithms, and that's all part of the AI programming that has to take place.
Is there anything else you'd like to add around the importance of a roadmap and how to plan and time integration?
That's a great question. I have several detailed roadmaps, and you can pretty quickly go down a rabbit hole. I had another client that was trying to design a similar process, and for each platform internally, they ended up with multi-page process flow documents. So the devil is in the details, and anything unexpected can really have a negative impact on a program like this.
Thank you so much. So I'd like to talk about data in more depth now. What kind of data do companies need? How should it be stored and in what format? And is Treasury getting a seat at the table as corporates set their data strategy? Amy, could I come to you on that?
This is very interesting to me. I was looking at a recent Economist survey, and the top 5 Treasury functions that turned out to be most in need of a data strategy were investments, cash flow forecasting, which is almost always at the top of any list, even though it's not sexy really, exposure identification and management, execution and settlement, and of course payments. So interestingly enough, payments rank a lot higher than receivables in terms of areas that need a data strategy. And I think the reason behind that is really has to do with managing the data that triggers the payments. So you have to have a really well thought out strategy for payment terms and vendor management and all that sort of thing. At a high level, and in terms of transaction banking, the payment files by type, whether it's a high value, low value payment, et cetera, same thing applies to receivables and also includes remittance data information. There are other areas such as customer service, and I mentioned vendor management already, data pertaining to know your customer data, anti-money laundering concerns, risk, again, with exposure identification and management. All of those are very relevant. And companies have to work very diligently to ensure the quality of the data is good and the integration is coming from multiple sources. If you think about it, they've got ERP, they've got TMS, they've got bank portals, they've got third-party providers such as a merchant processor, things like that. It really entails close partnership between Treasury and operations and the business functions and the data architecture and technology teams. So as bankers, I know Karen has seen this too, we increasingly see Treasury getting more of a seat at the table in setting the data strategy. I can cite one example. One of my clients established a cross-functional AI task force team for Treasury, and it included FP&A, it included procurement, risk management, and even marketing folks. And it was really critical that all those areas were involved to ensure a successful execution.
Yes, even more of an argument for strategic treasury. So what are the risks around AI regarding data, but also other factors like regulation and ethics? Should corporates give their data to fintechs? We also know other risks, like the fact data doesn't flag new risks and can limit perspectives. Karen, could I go to you here?
Sure. We see, if we start with the risks part of your question, there's probably three main risks that we see in banking and also see from our corporates. First of all is the risk in data security, being vulnerable to cyber attacks and data breaches. A second one would be operational risk. That could be if systems malfunction or the systems make errors and being able to stop that. And lastly, regulatory compliance. So I think what's important for all of us as we move forward is how we address those risks, fundamentally by implementing robust security measures and continuously monitoring and updating the AI systems. Lastly, with regards to regulatory standards and changing regulations, always will involve a human element and needs to be continuously reviewed. So I think that we all saw the recent outage from CrowdStrike, which highlights the sensitivity and reliance on third-party providers and how widely actually they're integrated across the value chain. With regards to fintechs, this is a varying space. I think fundamentally we've seen in banking that we partner with fintechs. However, they're not replacing the banks. They can provide a value add, but at their core do not provide the credit that banks have and the fundamental funding that we can offer. So we work together as partners. We do have numerous agreements between each other on how we share data, and that will continuously need to evolve with changing times.
Yes, and finally, could we sketch the future? Will AI ultimately make decisions and execute? Will treasurers instruct the technology to exchange a currency, issue a bank guarantee, downsize debt, or increase a bond offering? I don't know. How might it support sustainability?
Maybe I could kick off and give some ideas on the fluid nature of corporate strategy, which I think will always keep corporate treasury front and center as running and being the leader for maintaining the human element of AIs. Definitely, they'll be assisting in setting up the structures and parameters, but also sensitizing the elements. We always have bank relationships that play a big part in how we work with our corporates and how they work with us. Sometimes there's special situations such as downsizing debt or doing a bond offering, which can be influenced not only by human choice, but relationship value, which we don't think AI at this point is going to be able to manage well. We do see that AI can add value for customer and structuring risk profiling, as well as standard LC issuance when language is approved and standard. However, the human element will always need to be part of it. I would lastly say from a sustainability point of view, these initiatives are growing and refining themselves regularly. So while AI can help with the parameters that are defined now, we definitely see significant change in this sector going forward. Amy, over to you.
This one really resonates with me personally because of the sustainability aspect. If you think about it, AI really holds tremendous potential for advancing the UN's sustainability development goals, and that's something that Standard Chartered is very much in line with. If you think about outside of finance, there are so many applications to address, complex global challenges. For instance, AI can analyze vast amounts of data to identify trends and insights related to things like poverty, hunger, health, education, and environmental degradation, really. And by identifying, analyzing this data, they can enable targeted interventions and resource allocation. So, real world example of that is by analyzing medical data, AI can identify disease patterns, predict outbreaks. We just came through a pandemic, so this is really meaningful, and suggest preventative measures. And there are also applications with regard to climate action, agricultural sustainability. In short, all of these are really practical, helpful applications that, at first blush, AI can seem a pretty esoteric concept, but it provides really new opportunities to analyze data and trends at a pace and scale to further our knowledge and allocate resources to address these things.
Thank you both so much.
Our absolute pleasure. Thank you for inviting us.
Thank you so much.
You've been listening to Standard Chartered's Transaction Banking Sales Team, Executive Director Amy Beninato and Managing Director Karen Hom. I'm Sarah Rundell from Treasury Today Group. Thank you for listening, and if you'd like to hear more of our podcast episodes, please subscribe wherever you get your podcasts from.